All right, how's it going? Welcome back to the Day Trader's Blueprint. This is a five-part series that I'm working on to put out there that just goes over or at least what I believe to be things that underpin a disciplined trading approach, right? So this could be part four. It's going to be covering risk management, parts one, two, and three. If you haven't seen those yet, I'd encourage you to go back and review those as the flow of conversation kind of moves in sequence to parts one, two, three, four, and five. So if you haven't seen those, I would recommend going back there. But today we'll be on risk management. So let's get right into it. All right, risk management. What is it? What's the things that compose it? Why do I care? Why do you care? That's what we're going to talk about here today. So risk management refers to, a set of rules or strategies or things that you put in practice to help you employ and identify and minimize even losses while maximizing opportunities. So you want to be able to, use effective risk management so you're not depleting your account, right? Without an effective risk management plan, even skilled traders, people that have been trading for a long time, if you were to give them a lump sum of money and say, hey, trade this with no risk management, they'd probably have a hard time doing that because they're good risk managers. They've made it that far, but even a skilled trader who does not use good risk management, they're going to over leverage. They're going to take bigger trades than they should. They're going to hold losses. They're not going to manage the risk properly, and in turn negatively affect their account. Your goal, right, as a day trader, should be trying to ensure that you have money tomorrow to trade. So risk management acts as a safeguard. It ensures that no single trade or series of trades can wipe out a trader's portfolio, and it allows them to stay in the game long term. Here is a quick table that just shows you the importance of risk management, right? So this is portfolio lost on the left column and the gain required to make that loss back on the right column. So let's say you had $100 and you lost 10%, right? So you're down to $90. You have to make 11% gain on $90. So 10%, right, would only be $9. You're back to 99. You haven't broke even yet. So you have to make 11% just to get your $100 back. So you lose 10%, you got to make 11% to break even. Follow that table down all the way. You can see you get into the 50% range, you got to make 100% back. You get down into the 70, 80, where you're starting to approach that, account depletion zone. Now you have to really start making some big, returns over the future. Even if you were to, hit 70, 80% account drawdown, and get your crap together and say, okay, I'm going to take it slow and build this back up. You're looking at a 200 to 400% increase in that capital just to get back to where you once were. I don't know about you, but I'm not making 400% in a year with good risk management. I can make good money, but I'm not making 400%. Not consistently, not with good risk management, not responsibly. So that's going to take you some time, right? You can deplete 80% of your account relatively quickly. You can do that in a single day, a single week, but it's going to take you a very, very, very long time to make that money back, doing it the right way. So it's paramount. Just have good risk management right off the start, and then you won't see yourself, falling into this problem. Risk management and self-control go hand in hand. You can't really have one without the other, right? So you can't have good risk management without the self-control to follow that risk management plan. And vice versa, self-control is no good without a plan. Just because you're good at controlling yourself does not necessarily mean you're going to be good at managing risk if you have no risk management plan. So you need one with the other. They work hand in hand there. What are some key factors that comprise risk management is what we'll get into here next. But I wanted to talk about abundance mindset first, and that is simply understanding that tomorrow is a new day. The trades you take today, the opportunities you miss or take today, they'll have no bearing, no impact, no meaning to the next day, the next week, the next month, etc. Just because you take a loss on a trade today, it does not mean that you're going to miss the market, right? Or you're running out of time or anything like that. There's no reason to go on tilt and try to revenge your way back to make that single loss back. This is why I don't personally like to categorize my performance, siloed into like days performance or week performance, because it starts to make you think that any particular day is relevant to the next day. It's not. It's just total trades. I mean, if you make one trade today and 3 trades tomorrow, it's 4 total trades. It doesn't matter if today's trade was a loss or a win. It's 4 total trades between 2 days, right? Or 5 days, or 5 years, or 30 years. It doesn't. It's trades. How many trades you've taken. It doesn't matter what performance was for that specific day. That is a siloed, arbitrary mindset that means nothing in terms of your actual success in trading. So abundance mindset, it just means ensuring that you're focused on the fact that there's always going to be more opportunities, and to not let any single outcome of any single trade, cause you to not follow your rules. But in terms of key factors, let's get into that. So position sizing. Position sizing is a it's a big one, right? It's important. You have to have good position sizing. You're not going to take too much size or too small size and not make enough money, or too big size and blow your account. And I'll show you an example of what that looks like here. So here's NinjaTrader. This is an M&Q chart, live market. It's 11:42 right now. I've got this set to a sim account. I'm going to show you how I manage risk. Just looking at price right now. Right, we're in a downtrend, pivot up, down, pivot up, lower lows, higher highs, or lower lows, lower highs. Pivot up, retracement, continuation down, save the low. So if I was a betting man, I would say this low is probably going to get, ran at some point if price can't come up and take this high. Let's mark that out real quick. This is just some mechanical price movement, nothing special. Watching lows and highs get, ran to see if the live price is delivering in a trend, or if a trend is about to change. So in this particular example, without any other context other than just what I'm seeing currently on the chart, this low is, say, price is starting to move down, maybe I would take a short, right? So what I would do is I use a risk tool. I can hit Control Q in here, or Control W, and it's going to utilize a specific set, whatever this account, I don't know what the sim account balance is, but it's going to use 0.5% of the account, and that's how many contracts it's going to allow me to trade. So if I were to just, for example, use this high as my stop, I would mark it there, and I would come down and I would say, all right, I'm going to enter right here at the break of this low. You can see it's telling me I can have 7 contracts, right? If I was to enter somewhere up here, you can see the tool is telling me I get 21 contracts. So it's just relative to wherever the entry gets placed. It's automatically calculating how much size I can take while keeping my risk static. So it's always going to be that 0.5% on the account balance. Doesn't matter how many contracts. It's going to adjust my contract size, my quantity, based on how much gap there is between entry and stop. That's gonna be static at 0.5% capital risk, but the amount of contracts, the quantity, is going to be variable. So that's how I manage my risk. There's a lot of tools out there that can do that, especially for TradingView and also for NinjaTrader. But that is how I do it. That I think is a good way. By using a static percent, I allow my account to naturally scale over time, right? So if I'm making money and I'm doing good, that's going to compound, right? I make 0.5, say I make 1% today. Tomorrow I'm trading with 101% of that starting capital, and if I make another 1%, now I made 100, or now I made 1% on 101%, and it just continues to compound over and over and over. So your rate of increase exponentially grows. And it also helps scale you smaller on the downside. So if you start going into drawdown, it reduces your risk because that 0.5% becomes less size relative to your account balance. So I use a static percent risk of 0.5%. That ensures scalability both up and down. It ensures no single trade is ever going to wipe me out. If I were to try to blow the account on purpose, I don't even think I could blow the account on purpose because it would require 200 losses in a row to blow the account. And I don't even think it's just pure luck, I should win, at least probably 20-30% of those. Even if I was trying to lose, just out of pure luck, I should probably at least be winning 20 to 30 to maybe even 40%. Right? I mean, if I use a 50% win rate strategy, and I try to lose by taking the trades that I think are going to lose, it's going to be hard. It'd be hard to blow an account with 0.5% risk. I don't even think I could do it if I tried. So using that small of a risk comes with drawbacks. Yes, you're making less profit, but that's the nature of the game. That's risk management, right? If you're going to go bet 25% of your account, sure, you could make a 25% return, 50% return, 100% return on your account in one trade. But if you lose, right, you lose 25%. Well, now you've lost a quarter of your capital, right? And you got to make more than 25% back just to get to break even. You can see this goes back to the chart I'm showing you here on the right. For the amount of money that you lose on your account, that's what you have to make back. There's enough on position sizing. Let's go to the next one here. That's going to be risk reward ratio. So this is specific to the strategy. A sub 1 RR that can be profitable, but it requires a high win rate. Personally, I prefer targeting higher RR trades as it allows a lower win rate, putting less stress on, my need to be accurate. If I am looking at a trade setup and I think it's a good trade and I want to take the trade, I want to ensure that it has at least I will take a 1-to-1 if it is very viable, right? If I'm very confident, I need it to at least provide a 1-to-1. I'm not going to take a sub 1R trade. I don't have any desire to do that. There's plenty of 1 or greater than 1R trades that opportunities that I'll see on a weekly basis. I have no desire to take a sub 1R trade, right? That means I'm not going to risk, $100 to make $50. I'm not going to do that. I know people out there do that. To trade that way, you need a high win rate to be successful with that RR. So I prefer to have a higher RR, which allows a lower win rate. So for me, and I'll show you a chart here of what this looks like. There you go there. So for me, I like to be in the 1-to-1 to 2-to-1 area, right? So I'm risking, say, $10 to make $10 or $10 to make $20. If I can get more out of the trade, great. If I can get a 3, a 4, or a 5 hour return, great. But I want to at least make sure I'm somewhere in the 1 to 2 range. That's going to allow me to have a win rate of about 40 to 60%, somewhere in there. So if I can maintain a 40 to 60% win rate, somewhere in between, with hovering around a 1 to 2R, I can be profitable. I don't need to have a 90% win rate, or 80% or 70%, because when you start getting up that high, when you start targeting those lower R trades, you start requiring yourself to perform better. And when you're in a high RR state or a high win rate state, it can be a lot more draining on you emotionally, right? If you're winning 80% of the time, you took a huge that's going to mean that you're taking big win streaks with an 80%, 90% win rate. There are traders out there that have those, but they're trading sub R. They're trading sub 1Rs. So they're risking more than they're making. They're just winning a lot of their trades. That can be a little more draining on your mental state when you start going in a big string of wins. You start to get a little overconfident, and then you start to take a natural drawdown, and it's a lot more. It hurts a lot more to your mental state than if you're just winning and losing 50%, winning 50% of the time, losing 50% of the time, right? It's just like losses are more normal in that situation. Whereas if you're in a high win rate, losses are not the norm, so it's harder to deal with mentally. But that's why I prefer just a focus on higher RR trades, allowing me to have a lower win rate. So if most of my trades, they will fall in the like 2 to 3R. So as long as I'm maintaining around a 40% win rate, 50% win rate, I'm doing great. All right, next is stop losses. That should be pretty self-explanatory on the importance of that, right? So a stop loss is it's nothing more, right, than just putting a preventative order in place. I see a lot of people trade without a stop loss, and then if market starts to go against them, they don't know what to do. They break it. They'll close a trade arbitrarily, when they feel they've lost enough, or they'll average down, or whatever the case may be. But every trade you take, especially if you go back to part 2 where I talk about process, every trade you take should have entry criteria and entry trigger. The criteria is these things have happened that make you want to take a long or short position. And then a trigger, something additional happens that says, okay, enter. Now that could be criteria, could be oversold RSI, right? The RSI is down in the 20s. So the market's very oversold. It's due for a bounce. So you're possibly considering a long. And then your trigger could be moving average crossover of some sort, some short to long period crossover, like a 5 to 20 or like a 10 to 30 or something, where they cross bullish, and now you have a trigger. So your criteria is oversold market. Your trigger is possible trend change with the MA crossover. That is just an example. That is not a strategy. It's just using that as an example. Now, where you would put your stop is if the trend is changing because of your MA crossover, then you should see a low get put in, the market start to move up. So your stop loss should most likely go at that swing low that just got put in pre-MA crossover. You want to put your stop loss in somewhere that makes sense for the criteria and trigger that you're using, to where it would, if that idea becomes invalid, now you're going to close the trade. So that is where your stop loss initially should go. As the market moves, you can start moving your stop loss and going break even and trailing it and scaling out and yada yada. But every trade you take should have an initial stop loss to prevent that unnecessary extra loss. You put your stop loss at where you believe the trade becomes invalidated. All right, next one is daily and weekly limits, and I'm personally not a fan of this, but I would say this is specifically on the. I would say do not limit yourself to made up upsides, right? Like, if I hit 400 for the day, I'm done for the day. Don't do that. It's not a good habit to get in, because you're just limiting your profitability for no reason. Yes, it could help with mental state, not getting overconfident and greed and all that, sure. But in my opinion, why would you want to limit the amount of money that you can make to the upside? You should limit risk by minimizing downside, but why limit upside? If you've made a trade for the day and you hit $400, saying like, oh, I made $400 today, I'm done for the day. Why? Especially if you have hours left of your trading window. That's your process. You trade from, say, 9:30 open to 4 p.m. and you've already hit a couple $100 by 11 a.m. Why not trade the rest of the day? There could be more winning opportunities. You're never going to know the outcome of the next trade. So personally not a fan of upside limitations, but downside limitations, absolutely. Reason being is that as you progress as a trader, you can start to take off those downside limitations when you start to become more confident with your process. But in the early days of your trading journey, I think it can help. If you take 2 losses in a row, or you're down $400 for the day, or $1,000 for the day, or whatever, whatever makes sense for your account. Especially if you're trading props, they have daily loss limits, so you naturally want to cap your daily loss before the loss limit. So low downside limitations, I think, are good in the earlier days when you start to get more confident with your process. Then I would say trade every setup that meets your criteria. because you're never going to know the outcome of the next trade. It could be a win or a loss. There's no point in avoiding it. All right, next is contingency plan. This is referring to high volatility, broker issues, life events, etc. So something comes up that was unexpected, and it requires you to, react. Let's say, for example, you're in a trade and some wild news breaks out and the market just rips and you're long. It's going in your favor. It's probably beneficial for you to close that trade. It just ripped up for no reason that you were aware of, right? You'd have to go check the news and see why. But with any big spike in volatility, typically comes mean reversion shortly after. So you might get this huge bump that goes, maybe you were targeting a 1 to 2R and now you're up 5R. Close that trade immediately. That was not an anticipated move. That was not the expectancy that you were shooting for. So if you get some crazy volatility in your favor, close it. If you get some crazy volatility against you, maybe you were already up well in the trade, close it too, right? If it didn't stop you out already. Anytime you get unexpected volatility, where market is moving big, it's beneficial to just close the trade, right? Wait it out, look for another trade. There's no reason to be in market conditions that the market is moving against what you were anticipating. If you're anticipating a grind up to a high and a war news outbreaks or Fed or whatever, Trump, and it creates this massive volatility, just close the trade. There's no reason to get caught up in that volatility. Same thing for like a life event. Say somebody's in the hospital, they get a car crash or something, you have to leave, close the trade. Any number of life events where you'd have to leave your screen, just close the trade. Most orders, if you're in a live account, will reside on the exchange. So like on my personal account, if I put a stop order in, that gets sent to the exchange. So even if I turn my computer off, that order's still active. But with prop accounts, it might differ between the firms that you use, but with a prop account, it's SIM. So when you put a stop loss order in place, that order is not sent to the exchange, the NASDAQ exchange. That's not a live order. It doesn't get put on the book. That is just a SIM order, so it would reside on the platform you're trading on. Now, maybe in the back end, depending on what firm, they might have a system in place to keep the order live since it's a SIM trade. But typically, orders that are SIM based and not sent to a live market, they go away when the platform gets turned off. So it's just something to be aware of. So if you're going to be away from your computer for any reason and you're in a trade, close out the trade, in my opinion. All right, next is self-control. And I think this one, I think it's obvious why this one is on here. It's highlighted in yellow. This was part the part 3. Self-control was a topic covered in the last video, and they go hand in hand. As I was saying earlier, you can't have risk management. You can't have good risk management without the self-control to follow the risk management plan. So I don't think there's really much need to dive much into that one, but I wanted to make sure it got highlighted here as a key factor to any risk management plan. You have to have the self-control to continue to follow the plan. All right, and the next one is going to be adaptation. So adaptation is just your ability to monitor your performance over time, right? You want to monitor things. I'm not saying journal to the sense of like, today I felt bad when I took, no, not that. I'm talking about monitoring your performance to where you can make educated and beneficial adjustments over time. So if you start to see that, you're taking trades and maybe the entry, you're getting stopped out a little more than you should or something, and the market goes a little more against you typically. So your MAE, maybe you want to adjust your entry criteria to where you delay your entry on an entry trigger. Maybe your entry trigger, while viable and getting you on the right direction, maybe it's just a little early and you could get a better fill if you wait or something. There's just small, minute changes by monitoring your performance and your trade data that you could make over time while you're in the learning phase. And that's what this is referring, adaptation, being able to adjust and make changes as needed and then taking those changes into a backtest environment and looking for areas to refine. All right, next is going to be a study, but one more thing, just on key factors, I would say that these are what I deem as most important. I'm not saying this is everything, but I think by integrating these elements, you can shift from more of a gambling mindset to a systematic approach, right? So using good risk management and all these key factors, combining that, being aware of them, putting good practice with these key factors, that is how you're going to survive long term, and not chase short term gains, but ensuring that you're putting focus to long term performance. But anyways, a recent study in 2017, this was published by the Financial Analyst Journal. It was based on high frequency data from some major U.S. discount brokers. They tracked 1,600 day traders from 2012 to 2015, and they published this study in 2017. And it used transactional level data to assess profitability and behavior factors. The study found only 15% of traders beat transaction costs, with a median net return of negative 1.5% monthly. Yet, the top 10% who adhered to risk-reward ratios of at least 1 to 2, meaning they would risk 100 to make 200, and adhering to a position sizing under 1%, meaning they'd only risk 1% of their account per trade, they generated 12% annualized returns on average, outperforming the S&P 500 by 5%. So they beat the market by using proper risk management. That study, it just quantifies that consistent risk protocols and plans reduce variance in returns by 40%. It allowed winners to exploit short-term inefficiencies. And these risk disciplined traders, right, that top 10%, they exhibited a 2.3 times higher win rate, which was 55% versus 24% of the losers. And they got faster capital recovery post losses. So when you're looking at this chart here in the top right, they were able to recover their losses faster by using proper risk management than the people that were not using proper risk management. Because let's say you risk 20%, you lose 20%, and then you're like, oh shit, I gotta risk half my account now. Then you take another loss, so you're using huge risk and taking huge losses. Whereas the proper risk manager, they might lose 1% and then make 1% the next trade and they're break even, or make a 3% the next trade, right? So they're managing their risk properly, and they're not going into substantial loss, and they're able to make back their wins a lot quicker. So that study confirms that proper risk management is key, and using proper risk management is going to keep you out of unnecessary drawdown. And then the last thing here is expectancy. And that study, it talked briefly on expectancy, right? So it's how those risk management fundamentals turn negative expectancy into positive over a long-term period of time. So expectancy is your win rate times your average win. So let's say you had a 40% win rate. Your average win is $100. It's going to be win rate times average win minus loss rate times average loss. So if you win 40% of the time, it means you lose 60% of the time. And if you're doing a 2 to 1, then you're going to win 100 on your wins and lose 50 on your losses. So you'd boil down to $40 minus $20, or $40 minus $30 is plus 10. So you have a plus 10 expectancy. So over the long-term performance, right, you make 100 trades. These are your win rates and your averages. You have a plus $10 expectancy. You have positive expectancy into the future. So you can say, I'm expecting to be profitable long term. Some on these prop leaderboards, you'll often see win rates and average wins listed, and you can start to derive the expectancy of these traders, and they have negative expectancy. Top Steps or some of the other ones that have those stats on the leaderboards. If you look at a leaderboard that shows win rates and average wins, you can derive the expectancy with this equation here. If they have negative expectancy, they're losing traders. They're not good traders. They're just good gamblers, and they've probably spent thousands of dollars, racked up hundreds of evals, and you're just seeing the ones that they make money on. So it's in the prop game, it's a lot different. Don't get bent around people's performance because it's misleading. You can buy an eval for $40 and blow it 10 times, lose $400. You've blown 10 evals, but then on the 11th one you make $3,000, right? So if that was real money and they're 50K accounts, you'd have lost $500,000 and only made $3,000. It's not realistic, right? So what they should be showing on those leaderboards is how many accounts these traders have traded and the net loss and sim capital that they've lost, or just show the net loss and sim capital or for blown accounts, and then show profitability. I guarantee you, anybody with a negative expectancy has blown more sim capital than they've won in payouts, hands down. That's what that means. But all right, let's move on. So that's it for risk management. The next topic is going to be strategy refinement. That'll be for this Day Traders Blueprint 5-part series. That'll close it out. We'll talk about strategy refinement, just from start to finish of how to better refine your strategy, things you could do, stuff you should be looking at to take your process and make it better. So that'll be part 5, and that'll close out this series. But if you have any questions, feel free to let me know. Take care.